we have an amazing panel right now, okay? And this panel is all about how do you reach out to MSMEs in a more sustainable way, okay? So Raja Debnath, Veefin is a supply chain finance platform. We are a white label solution. We provide a solution to fintechs, banks, and NBFCs. So that's a short blip about us. I would ask the panelists to just refresh the audience with what they do. Couple of lines.
Hi, I'm Sanjeev Chandak from ftcash. We do small business loans for local mom and pop neighborhood merchants. It's typically a working capital loan, and we in fact combine it with digital payments to keep our credit risk pretty low. Thanks.
I am Aseem, Dhru. We are building SBFC Finance, which is basically focused on lending to small businesses in small towns of India.
Hi, this is Sundeep, Mohindru, CEO M1 Exchange. M1 Exchange is commonly known as Trades as well. We run supply chain finance for SME enterprises.
Hi, this is Deepak Jain. I run a fintech platform called FlexiLoans. We give loans to small and micro entrepreneurs across the country. We do with a combination of a term loan and a supply chain product.
Hi, Ketan Patel. I head Mswipe, and we are a payments company which is into lending. So we lend to small merchants, basis the payment transactions that they do with us.
Thank you. So, since morning we have been seeing a lot of fintechs. Everybody's lending. So, when there's so many players who are lending, why is there still a lending gap? Every year we keep hearing the same thing. There's a gap, MSME financing gap is increasing. And we have so many models, so many lenders. So, why do you all think the gap is still existing? Anyone? Or all?
Just adding a spice to your comment. Yesterday I was with a very large bank, private bank, and he said most of the banks this year has PSL in excess.
Wonderful.
And PSL is trading at 0.1% this March versus the rates which have been going earlier about 0.75%. So just adding to your comment.
So banks have seemed to be doing a better job, but still there's a gap. Otherwise, we should not be existing.
Here, there are 63 million odd merchants or small MSMEs in the country. Last data that I read, 7 million had access to formal credit. Multiple reasons why there is a gap. If you look at the bureau data, 90-day plus NPA is around 12.5. So that is the first red flag, right? Nobody wants to get into a business where the NPA is 12% plus, right? To do unsecured lending to these MSME, you have to be a superman, right? Very few players have been profitable in this segment. Very few. A lot of people claim to be profitable, but when you look at data, nobody is profitable as such, right? Very few are profitable. And there is a reason. Very difficult segment. All these guys that the MSME is banked, right? Their own banks don't want to give them loans. Maybe it is the ticket size, maybe it is the fear of losing your money. So the gap is always going to be there, and that is the reason why people like us have the opportunity to fill the gap. So that's the reason why all of us have some business to do.
Yeah. So of course, we all know that the financials of an SME are still not that trustworthy, or you may call it, or not that spick and span. And a substantial part of the business is building up on the GST side, on the cash flow, cash versus bank side. And the P&L has, you can't evaluate, it's not credit rated, it's not, any credit rating is not there for an SME. So it takes a while, like Ketan has said, it takes a while for anybody to give a loan to them offhand like a large company. So this gap will always remain till the time the SME financials are not up to the stage which can be relied upon 100%. So it's a trust which will help to build this business.
Yeah, Deepak.
So See, most of us fintechs, or the new age lenders who went into the tier 2, tier 3 towns and are trying to solve that gap, we started with this model of flow-based lending. And MSME lending is the most complex algorithm to solve there, because the flows for this MSMEs is a mix of digital flows or real flows in the bank account statements and the flows in the form of cash. Now, this cash flows, you cannot build a model for that, right? It's very difficult to bring alternate scorecards to really gauge what's the real income of this small retailer. So, in I would say lack of ability to do this flow-based lending in the most accurate manner, I would say that this segment is still extremely underserved than what it should have been when so many of us started doing lending. Because, like for example, on our platform, we get almost 1.5 million leads every year. We would have received almost 9 to 10 million leads on our platform till date.
And
We should have given.
What's your approval rate?
Yeah, it's minuscule. It's less than 1%. So that's because we lose customers at pin code we don't service, at sectors we don't service, at bureau profiles we don't service. The flow is not enough what we want to look at, and thus we don't still have those scorecards. Now that's the reason why it is not done. But with what is happening on the technology, and now let me bring you to the slightly positive side. With first GST and now account aggregator happening, and the whole digital push towards payments players and the QR players, we are seeing a massive shift. The cash is genuinely getting replaced in tier 2, tier 3 towns with digital payments. And this will allow a lot of the lenders who are building scorecards for the small and micro retailers to finally be able to lend to them. So you'll see these numbers enhancing or increasing at a very, very good compounding rate in the years to come.
I'll come on scorecard. So, Aseem, you had a point to add.
So I'm the guy with the maximum gray hairs in the room, so I will take you a little further back in time to answer this. Indian banking evolved in two stages, 1947 to 1995 and 95 onwards. What changed? From 1947 to 1995, the model of nationalized bank was retail customers gave deposits and they would lend to corporates. This has been the model on which the entire nationalized setup was built. There was no concept of consumer loans that was there at all. In fact, when HDFC Limited started, State Bank of India had home loans in the negative segment. They were not lending for home loans. So at that point of time, HDFC Limited started. So if you see what happened was that the history of NBFCs in India, in a sense, began with HDFC, where they started filling gaps left by nationalized banks. And it began, so if you see the history of NBFCs from early 90s, you will see that Kotak Mahindra, for example, when it was an NBFC, started with bill discounting. I don't know how many of you remember those days, but bill discounting was a business actually. Then there was City Financial, which introduced auto loans in the country for the first time. And then other people picked up, and Santro booking and Indica booking and all became a large business segment for that particular segment. Bajaj Finance came and picked up consumer durables as a segment that banks left. So the NBFCs came in and picked up segments that banks left. 95, when private sector banks came in, they started slowly understanding the retail business and getting into retail in a big way. So from 97 onwards, private banks started building the retail lending franchise. And after that, they came into the SME lending franchise after building the retail franchise. What happens for a bank, and having built this business in HDFC Bank, I can tell you that for a bank, a lot of these businesses don't make sense. Because for a bank of that size, unless you are a $15 billion portfolio, you don't want to waste your time building it. And these portfolios typically don't get that large. So for a bank, it is not worth their while. It is very tough to crack this segment. It is not worth cracking it. So they have left these segments and they focus on the higher end of the MSMEs. So there are businesses and there are businesses, and MSMEs comes in all kinds of shapes and sizes. So they focus on the higher end of the business where cash credits, term loans, all those larger limits are given out. LCs, bank guarantees, etc. So that's a different segment of customers. So this segment of customer is kind of it's not that he's getting missed out, he's getting left out by design. And NBFCs typically, as the history of NBFCs have always been, they get into segments that are left by banks. So it is the life of an ant. You know, the elephant eats the big trees, the ant picks up whatever is left that the elephant misses.
Yeah, Sanjeev.
So I think, no, I mean, yes, obviously, no, banks don't want to touch the micro and the small entrepreneurs, right? I think, no, in India, we also have about 10,000 NBFCs. But even then, no, the question remains that there is still a big gap. My sense is that, no, I think MSME lending is hard as compared to, no, somebody who, let's say, gets a paycheck and you do a consumer lending based on CIBIL and paycheck. I think in MSME lending, no, as Deepak said, right? I mean, there are a lot of data points. Nothing is standardized. Half of it is in cash, half of it is digital, right? So it is really hard. But at the same time, with tech, I think if we can break that cycle, what is extremely important is the ability to manage the credit risk. If we can know, if anybody can break that cycle and actually manage the credit risk and keep it within, I would say, appropriate levels, this is fairly big segment to crack in the next few years to come.
So just jumping on to what you spoke about in terms of scoring. So there's a lot of talk about data points, alternate data scoring, social, behavioral. So what have you all seen actually working? One is reading about it, one is talking about it, and one is actually seeing it actually make some sense. Because I remember had done a project with Xiaomi in China. They had 2,463 variables, okay, that they were using to do an underwriting. Not sure how many of them actually were statistically significant, but in your views, all of you are in lending, what data points do you actually think make sense? Which are new age? Anyone? Who would like to go?
I can go first. So, again, all of us will have, thousands of data points which eventually our scorecards are getting trained upon. There are two different points. The number of data points we are looking at while scoring, as well as number of data points where the models are getting trained upon over a period of time. Now, all of us need to process, I'm not saying do loans, all of us need to process at least 1 million loan before some of these alternate scorecards will start making sense. So will the time come for them? The answer is an absolute yes. But is it today already? The answer is no. However, there are many other data points which you can use. Like for example, we started a program for lending with Mswipe long back, almost 2017. And we scaled this portfolio significantly. So we, at FlexiLoans, for us, majority of the business happens via ecosystem. Almost 70 to 80% of our business is via various ecosystems. And we use a lot of data generated via these ecosystems. If it's payments, it's the payments ecosystems, the daily transactions happening on the QR codes or the POS machines. If it's e-commerce, it's the, how much the merchant is selling, what kind of products he's selling, what's the cancellation, etc., etc. Now, a lot of this trail of data of purchases and sales, which are available through alternate methods and not just in bank statements. Can you tap into that data? That's also another source for financial data, which is very critical for making your lending decisions. I think so that's the major or most important source of data most of us are using. Beyond which, there are some behavioral scorecards, etc., which are more for, understanding the propensity to collect. That's not for decision making whether to lend, but that is also used like a go no go, that okay, whether we'll be able to collect in this from this cohort of customers, and we use that.
Anything anybody else is using specifically for collections?
Yeah, so actually, we use a lot of data points for collections, right? So the propensity to collect, or whether we think, we will be able to collect in the next 7 days, right? So that is the benchmark that we use with decent accuracy. Obviously, it keeps on improving, but with decent accuracy of around 80%. What we see is obviously, payment data in terms of what sort of digital transactions the customer has done. We see also a lot of behavioral data, right, in terms of the feedback that the collection team has had with the specific customer. So for example, how many times did it take you to reach and connect with the customer before the customer picked up the call, etc., etc. So that has been fairly useful for us to, I would say, tweak our early warning system that, okay, If we think the person is not collectible, then no use immediately go into hard collections.
Ketan, you wanted to add something?
Yeah, so since I come from the payments ecosystem, we've kept our life very, very simple. We've built tech around it. Lending, and Aseem sir will tell you, this is a very simple business. Knowing what not to do is more important than knowing what to do. A lot of people don't understand that. And so, our credit norms were both, we have a collections business where we offer that to other NBFCs and we collect for other NBFCs also. But on the payment side of too, what we've done is we've created our entire credit norms basis the data that we have. So for a merchant to get a loan from me, he has to be in the system for 6 months. I look at all, anyway, see, a payments company is anyways taking a call on the merchant. There is a credit limit assigned to him, right? If there is a card swiped on his terminal, I am making good the payment the next day, but I'm open to a chargeback for 180 days. So I am anyways taking a call. So we have dynamic credit limits on each merchant basis the MCC, basis the PIN code, basis his track record with me. I have a dynamic limit, and within that dynamic limit, I give him a loan. So the limit will be last 6 months average transactions. I will not give him a loan above that. I also look at data on are there any chargeback requests which have come in. I look at how many debit cards, how many credit cards. Are there same cards being swiped month on month? Is he adding new cards? So multiple data points and basis that we lend. We also created a joint score with Equifax for this, right? And on the collection side, we use the same data. Like there is a Raja who is running a shop and his shop is shut only on Sundays. I know it before I give him a loan. If for some reason Monday the shop is shut, I will call you on Tuesday to check everything is okay with the terminal, with your shop and with you. If you still don't transact on Wednesday, I will send somebody. So lending is not about underwriting, it is also about collecting, right? And we always believe that if you are first in queue, your ability to get money will be better than anybody else. So the other guys will realize this when the EMI bounces. A month later, I will realize it on the second day itself. So my ability to collect, and he'll normally, if you are first in queue, he would want to clear you, come what may. So this we've used in tech, simple business, common sense, that's what we use.
Uncommon.
Lending is a very simple business. It's collection that's damn tough. So if you actually look at the lending business, in the end, what are you doing? You're just trying to figure out the ability and the willingness of the customer to pay the loan. You may cut it this way, that way, whichever way you cut it, but this is exactly what you are trying to do. Now, what digital has done is that it has compressed the ability for us to figure out the ability to pay. So because you are able to crunch through data efficiently, what the human mind was doing. I mean, just imagine, in the good old days, we used to look at a 6-month bank statement manually. We would go through it like that and say, okay, 1 bounce, 2 bounce, 3 bounce, calculate. And then somebody will appeal. The sales guy will say, no, I don't agree. It's not 3 bounce, it's 2 bounce. So again, they will calculate. This was the way it was done. Now, machines do it and give you the output instantly. So all you need to do is figure out willingness to pay. And for that, we still believe that feet on street, old credit method, touch and feel, still works, in that delivery. So you do that. So in the end, whichever data you use, unless you have got 1 million to 5 million loans tested on it, scorecards have no meaning because you really don't know how these information triangulates to give you a particular default rate. Because lending is not a game of certainties, it's a game of probabilities. So you are trying to play the probability game and trying to increase your odds of winning and reduce your odds of losing. So effectively what you're trying to do is that you're trying to train your model, program, whatever you call it, but you're trying to or whether it's artificial intelligence or natural stupidity, whatever you prefer. But in the end, all you're trying to do is trying to figure out what is the way for me to manage my risk at the optimal level. Because in our business, there are only 3 things we need to manage: cost of operations, cost of funds, and cost of credit. The rest is mere details. Business is irrelevant, just as the old Tata Steel ads went, we also do lending.
So, touching on the point on collections, because Ketan, you said that you also have your company providing collection services to other NBFCs. So we're seeing a lot of collection as a service companies coming up. Are you doing it end-to-end, everything on collections, or only particular bucket?
No, we want to do end-to-end, but at this point in time, we are focusing only on 180-day plus. What we've realized is, while we were lending, like Aseem sir said, we focused on collections first. We are lenders, we want our money back. Unlike a lot of lenders who feel that we'll try and see whether that money comes back or not, we don't have that thought process. We are Gujaratis, bankers. If we are lending money, we want money with our interest, we are happy. With penal, we are more happy. So that's the basic thesis. We collect 180-day plus, so we invested a lot in tech, basis our experience. We realized, and like Aseem sir said, tech is great for skip tracing, tech is great for planning the route, tech is great to know whether the guy has gone there or not, has he visited or not, but you will have to send somebody to collect money, right? So it's a combination of digital and physical. Digital will help you trace the guy. Digital will help you plan your resources well so that, you can do maximum visits, collect maximum money, make the best out of it, and reduce your cost. And we realize that there is no pan-India player, right? Most of these collection agencies are either city-specific or region-specific. With Mswipe, we are present in 650 plus cities, right? We have 2,000 people on the field. It's an additional income for my guys and the company. So we said we have the ability, we are a tech company, we are already there in the pin code. For us to hunt the guy down, both with tech and our physical presence should not be difficult, and that's what we are doing.
So a question to a few of you. What is your view of companies who outsource their entire collections to people like Ketan or collection as a service outfits? What is the view? How sustainable do you think those models are?
Yeah, why are you trying to
नहीं
take
मार
away
रहा हूँ,
my
पेट पे
livelihood?
नहीं मार रहा हूँ मैं, but I'm just as a because they are investing.
You are making me feel like a suited booted pathan here.
कौन लेगा? Aseem?
So see, this is where philosophies differ. There is no one right model or one right way to do it. You can do it in multiple ways, and so all retail we understand today was taught to us by Citibank. And when they came into India, they put out this whole model of DSA, CPA, this whole thing that now what you work on, outsource collections, outsource call centers, all of this was put out by them at that point of time. That was way back in time. Not much has changed since then, and Ketan is right that there are, the challenge for banks is that they are dealing with multiple agencies. There is no countrywide agency. There is no one agency that deals with everything. So at each state, at each city, they have to deal with multiple agencies. So even today, most banks outsource their hard collections. So they will collect up to 90. But when it goes beyond 90, when it becomes an NPA, especially in unsecured, they outsource collection. So even today, it is outsourced. Now, what he's trying to probably do is centralize it rather than allow it decentralized.
So, keeping to time, let's move back to something which I'm sure many of people sitting here will find interesting is, what are the business models on the MSME side that you all find particularly interesting, which you think have the legs to scale themselves up? Like across the panels that I've been hearing since morning, supply chain very clearly comes out. Like supply chain is one of the most important things. Anywhere where there's an invoice, very important, embedding, important. So a couple of things which the government is pushing a lot is on the OCEN network, okay? And GSP Sahay. GSP Sahay has not done too much, but what is your view? Do you think these two models have the legs to really scale up? OCEN, GSP Sahay, yeah, Deepak.
So, I'll address the first part of the question where, what are the new models which I see and, specifically on supply chain. So in one of the questions earlier, we spoke about the various data models which you can use for lending, right? Now that supply chain is one of those data points. So supply chain based lending or supply chain based financing is a massive industry. I think so banks are doing it for a long period of time. But there is, even within this industry, and coming from what Aseem said earlier, that there is elephant and then there is an ant. So there is a long tail of supply chain which is missed out. Long tail of anchors, which are like smaller anchors, and long tail of vendors within those each anchors, larger anchors as well. I think so that's where a lot of us, who are doing supply chain financing are focusing. And within that, there is vendor financing, there is dealer financing, and that now this whole B2B BNPL, which is, reaching to the end mile retail via these distributors and giving them a real-time payments like lending solution. I think so each of this has enough wings to fly, and, done with right mix of technology and underwriting discipline, I think so this can scale really well and do wonders in terms of number of loans which can get distributed in the industry. Second part of the questions, even GST Sai and Oaken will also scale, and we are a firm believer in that, and that's why we are integrating with that.
Sure. So I think this is Sandeep. Let's get Sundeep in first, and then I come to you. Sundeep.
No, so I fully endorse his view, and I am only a supply chain finance person. And started our journey from that, and we're probably going to end whenever on that only. And we've seen the days when banks never used to understand digital supply chain finance, and can I finance an invoice by looking at the invoice on the screen. Today we've reached a stage where every bank has a desk comprising of two people, one person, and they're doing supply chain finance. Just one desk or a two desk. And with that two desk or one desk, they are building a book, minimum about 400 crore to 500 crore a month kind of a book with one person. And this is possible with one such vendor finance module called Threads. Right? Now, and correlating it to one of your previous questions of modeling or the credit analysis, in the last 4 years, the history that the supplier and buyer have left on the Threads platforms, now the credit analysis is being done on the supplier. So on the buyer being a large company, of course, this credit analysis is available in large quantity. And the supplier, like we said, his financials are not fully reliant. And that's where he has left a lot of legacy points about his dealing with the buyer. And like Aseem was saying, his ability to repay and his willingness to repay is something that you are able to check with these data points. And this supplier now is becoming a buyer on the platform. That means he's going to buy his raw material from another tier 2 SME. And that's started to happen on Threads now.
So you're saying that you no longer require the anchor, so to speak, to approve an invoice. Without approval of the anchor's invoice, are you ready to look at the past data points now and provide limits?
No, so these are two different things. One is whether the anchor comes and approves. Yes, it is fully required. Without it cannot happen. But if the supplier is giving to a large anchor, can that supplier also buy his raw material from another supplier, and basis this tier 1 supplier's credentials, can we finance him for his purchases?
Interesting. Yes, Sanjeev.
Yeah. So, I think, if you look at the long tail, right, it's a credit-starved market. If out of the 70 million MSME, if you look at it, 60 million don't have access to credit. So my view is that, these folks will take the money if you give it to them in any shape or form, right? Whether it is discounting, whether it is working capital, whatnot, right? I think it's the lender's ability to manage credit risk is what is critical, and some people will manage credit risk using alternate data. Some people will manage credit risk using, let's say, a buyer and a seller invoice, etc., short-term credit, etc. So I think there will be different types of lenders who will say that, look, we are able to manage credit risk better using this form of a product and this form of a data. I think as long as that's there, no, I think any business model will survive if you are able to keep your risk low and margins high enough from a pricing perspective.
I'm not sure whether regulation allows this. So with your gray hair, you can say, with so many lenders lending, and if collections is the primary issue which is there, obviously, you have to collect. Is there no way of collaboration between the lenders on the collection side? No, bureau is post facto. Bureau is post facto. Is there nothing which, other than that, which is possible, just a blue sky thinking, which allows collaboration between lenders to, I don't know, pool in resources or XYZ to collect better from these customers?
So what is your key thing that you do as an organization? How comfortable are you in outsourcing what is key to you? Because ultimately, one of the ways, see, this business is a very simple business. There are only two kinds of lending: secured lending, unsecured lending. There are only three kinds of security: property, wheels, and gold. This is the end of it. Now you cut it this way, that way, whichever way you want to cut, but this is the end of it. 11,000 NBFCs have always existed in India since 1990. Every 10 years, one storm comes and one-third of them disappear. New ones come up and next storm they disappear. This has been the history. 97 the first storm came, 2007 the second storm came, 2017 the third storm came. So every 10 years a liquidity cycle happens. Now what happens is that when you are building a business, one of the core things that you do differently, because ultimately what are you trying to do? Everybody is more or less doing the same thing. What are you trying to do? You are trying to execute better than the other. So it's a business of efficiency. It is not a business of innovation. And fundamental problem is that regulation and innovation don't go together. So this is the problem. I don't know how many of you in this room know that the only business Elon Musk failed was for fintech. He started with a fintech called X.com. And his thought was that he's going to completely revolutionize banking. He said bankers are idiots and we are now going to change the way banking will be done in this country. So he started X.com and his failed version became PayPal. It became a limited application because he couldn't fight the regulation. So the everybody deals with different challenges. One of the ways you execute better is collection. That am I better at collection compared to others? Am I better at credit compared to others? Am I better at origination compared to others? Ultimately the game is only this. Now if you give away one of your important pieces, which is that I collect better, that could be a pain area for you going forward.
Absolutely. Pain area for sure. So I think keeping to time, I'll open it to audience questions. I'm sure the audience will have some questions for this panel. Yeah. Third row. But I have to give audience questions because in one of the panels, because you did not have time, somebody got really angry. Yeah.
Okay, so it was really nice learning about the opportunities of bringing credit to MSMEs. I just wanted to know what are your opinions on equated daily installment loans, which companies like Neo Growth are doing, and we ourselves are just stepping into it. So we are getting very good response from tier 2 and tier 3 cities. But what I hear is that it is very difficult to scale up. So would like to know more about it.
Ketan.
Yeah, that is the only business that we know. Loan against POS receivables is the only business that we know. I don't know any other supply chain financing. Whatever was mentioned out here is all Greek and Latin for me. Loan against POS receivables is what we do. And it's an outstanding business, scalable. There are 45 odd million merchants who are using either QR codes or POS terminals, right? Of this, around 30 million are transacting on a daily basis. You lend to them and collect on a daily basis, you are sorted. So this is a completely scalable business. A lot of people now have started focusing on that. We understand this business and this is the only thing that we do.
I think
we've got also a lot of good success with that because you're able to match the cash flows for the business owner, and it really helps from that risk management perspective.
But one thing you have to remember what Ketan had said earlier, that while underwriting, they know that the shop is closed on Sunday. On Monday, it's not there. On Wednesday, the guy is there. I think because you have multiple POS machines at each counter. So the ability of being able to have your person visit there, go there, collect, the moment this guy does not want to pay you and wants to start swiping on the other card, I think that's the key. And you will get people, as many of you here, they've said, lend करने के लिए लोग, you will get enough. How you collect, everything boils down out there. Question.
Hello.
Mic पीछे.
Hello. Hello. So, my name is Priyanka. So we have heard a lot about net zero and India aiming to be net zero by 2070. Hello?
Yeah.
Yeah. So we have heard a lot about India being net zero by 2070. So I just wanted to understand where do we stand in integrating the ESG initiatives and implementing them with the supply chain finance?
Supply chain finance, Guru. So what she's saying is that India has to be net zero by 2070. So from the ESG perspective, supply chain finance will play a very important role. So what's the views on that?
No, you're very right. The supply chain finance companies globally have started adopting ESG as a tool or a mechanism to enhance it. And it is not yet taken any steps, not substantial steps have not been taken in India regarding this. Primarily because it's only the measurement tools or the measurement criteria agencies in India is still not standardized. Having said that, it has to come, it is going to come, and it's a matter of some time that supply chain finance will have ESG bundled in it.
So if your customers are in Europe or in the US, ESG is mandatory because if your buyer is there and your supplier is sitting in India, they will ask you to be ESG compliant because it will either be scope 1 or scope 2. So from that point of view, and that's where deep tier vendor finance actually comes into play. Because that's where you are able to go down into various tiers and incentivize the lower tiers to actually follow the ESG parameters at various pricing points so that the buyer can meet the ESG norms. Yeah, Deepak.
So also, Raja, the awareness on the ESG is slightly better now because a lot of lenders and equity investors are ESG backed lenders. And thus, with those norms, I think so many of the lenders are following ESG norms to avoid sectors which are non-compliant and so on and so forth. So that's also increasing a lot and thus, will create an impact in the long run.
Thank you so much for the insightful discussion. Aseem sir mentioned that it's more of an efficiency game than an innovating game. The question is, what are the top maybe 1 or 2 most inefficient parts of MSME lending today, either on the customer journey side or on internal processes, which you feel if automated could take MSME credit to the next level?
So one of the biggest challenges is origination. And what has not got digitized is customer origination, especially for MSME. So the challenge really has been that even today, we have feet on street who actually go and visit their businesses to find and prospect for customers. So somewhere I think, and we are a secured lender, so unsecured lenders still are able to get more direct origination. For secured lenders, the challenge really is to be able to originate digitally. And without spending big bucks on buying Google AdWords and this, that. So if you do not wish to do that, then it becomes a very difficult proposition to originate. So there, if somebody can solve for that, that could be a major area. And second, is that the what happens is, see, to us, all these are technicalities. Supply chain financing, ESG, this, that, etc. To the customer, he wants money. He's not looking for something very complicated. He's not really looking for a particular kind of a product. What he's looking for is money. And, who will, amongst the lenders, there are so many lenders, amongst the lenders, who can give him the best solution, is something that he needs to be directed to. So somewhere, maybe in collection, coordination may be difficult, but in origination, maybe coordination is possible, and cohabitation is possible between secured, unsecured, and supply chain and various lenders that are doing niche areas of business.
Hi, I have a 3-part question for Ketan. So your POS financing that you speak of, that sounded interesting. What's the interest rate that usually applies to such financing? What's the term period for such loans? And what's usually the default rate across the board?
So the interest rate is anywhere between 1.5% to 2% a month.
Okay.
Depending on how strong or how weak the person is, right?
Okay.
Tenure is between 12 and 18 months, and like I said, I don't give more than 1 month transactions with me because I don't have access to, like Deepak was saying, cash I don't have access to, right? I have only access to my transactions happening on my terminals. So I give him one-time monthly transactions for the average monthly transactions for the last 6 months. So tenure is 12 to 18 months, and we've not reached, we've done 100 crores of disbursement on our books. My 90-day plus is 1%. So we feel that we have the beginner's luck, but the real show will happen only once. This is a trailer, yeah. The movie starts only once you start crossing 500 crores. So taking baby steps. We are a collections first company. So unless we have the collections infrastructure in that town or city, we will not lend.
So at this point in time, it's 1% default rate.
Sorry?
At this point in time, it's 1%.
Yeah, 90-day plus is 1%.
Okay.
And we want to be there. We are not in a hurry. We are marathon runners. Like I said, we and Aseem sir will relate to this very, very easily. We don't want to be Unilever. We don't want to distribute. We want to be a Kotak or a HDFC. We want our money back.
Okay. Thank you.